Hello again. The second part will take CVP analysis beyond break-even analysis, moving into profit planning to ask questions such as how many units does the entity needs to sell in order to achieve a targeted profit. We will also look at CVP analysis for multiple products and a set of assumptions underlying CVP analysis. CVP analysis can be used to calculate the number of units you need to sell to achieve targeted profit. There are two types of targeted profit that we're going to look at here. Targeted profit before and after tax. First, targeted profit before tax. An entity would want to earn profit to use for maintaining the current business operation or even expanding the business. Both the sale quantity and sales revenue associated with targeted profit needs to be calculated. Remember, sales quantity to break even is calculated from total fixed cost divided by contribution margin. Therefore, if you have a targeted profit before tax, you need to add the values of profit before tax and total fixed cost. Then the sum of these values divided by unit contribution margin will give you the number of units you need to sell to achieve that targeted profit. If you want to know the sales revenue, the total fixed cost and profit before tax divided by contribution margin ratio. So depending on which data you have, you can calculate either sales quantity or sales revenue. Let's revisit Dina Furniture as an example of targeted profit. You are required to calculate the number of units and sales dollars required to achieve a targeted operating income of $100,000. Sales quantity equal to fixed cost plus profit before tax divided by CMU. $100,000 fixed cost plus $100,000 profit before tax equal to $200,000. $200,000 divided by $40 contribution margin per unit equal to 5,000 units. So it means Dina needs to sell a total of 5,000 units to be able to achieve 100,000 profit before tax. Calculate sales revenue by using contribution margin ratio. Sales revenue equal to 100,000 fixed costs plus 100,000 profit before tax equal to 200,000 divided by 40%. Sales revenue equal to $500,000 in total. Another way to calculate sales revenue is from multiplying the number of units, 5,000 units, times selling price per unit, $100, you will have the same result, $500,000 sales revenue in total. Number 2, targeted profit after tax. Sometimes some entities want to achieve a profit as an after-tax amount. For CVP analysis, we need to convert profit after tax to a profit before tax. This process often called as grossing up. The formula is profit before tax equal to profit after tax divided by 1 minus tax rate. An example here, assume a tax rate of 30% and an after-tax income of $70,000 is required. How many units need to be sold? First, you need to gross up the income to a before-tax basis. Profit before tax equal to $70,000 divided by 1 minus 30% tax rate equal to $70,000 divided by 70%. Therefore, profit before tax equal to $100,000. After you have the value of profit before tax, then you can continue your calculation of targeted sales in unit or in sales dollar revenue using the previous formulas. Let's move on to CVP analysis for multiple products. CVP analysis is quite straightforward when applied to a single product or service. Organizations often sell different products or services. Using break-even analysis when multiple products or services involved It requires the assumption that sales mix remains constant. Sales mix is the relative proportion of sales units or sales dollar that comes from each product or service. You then need to calculate weighted average unit contribution margin. It is the average of the product's unit contribution margin weighted by the sales mix. Weighted average unit contribution margin is used to determine the break-even point or targeted profit in units. The weighted average contribution margin ratio is used to determine the break-even point or targeted profit. The formula to calculate break-even point in units is total fixed cost divided by weighted average unit contribution margin. Let's look at an example for break-even analysis for multiple products. Comfy Furniture has now been operating for a couple of years. Sales have been growing and management have been excited about business performance. Currently, the business sells two very popular items, tables and chairs. Next year, the estimated total sales are 25,000 units and the breakdown per item together with financial information follows. Sales in bracket estimated units, tables 5,000, chairs 20,000. Sale price per unit for tables $100, chairs $50. Variable cost per unit for a table $60, for a chair $25. Total fixed costs are expected to be $280,000. Required, calculate the total units of furniture to be sold to break even next year. Show the number of units for each product type. In the case of CVP analysis for multiple products, first you need to calculate sales mix. Total sales from two types of product, tables and chairs, equal to 25,000 units. Therefore, sales mix is the proportion of estimated sale per product out of the total product. Tables equal to 5,000 divided by 25,000 equal to 0.2, that equals to 20%. Chairs 20,000 over 25,000 equals to 0.8 or 80%. So these are the sales mix for Comfy Furniture. We then need to continue to calculate contribution margin per unit. For tables, sales price $100 minus $60 variable cost per unit, contribution margin per unit equal to $40. For chairs, $50 sales price per unit minus $25 variable cost per unit equal to $25 contribution margin per unit. Sales mix for tables 20%, chairs 80%. To calculate weighted average contribution margin per unit, multiply sales mix with contribution margin per unit. In this example, 20% times $40 plus 80% times $25 equals to $28 weighted average contribution margin for this company. Total break-even point equal to fixed cost divided by weighted average contribution margin equal to 280,000 divided by 28 equal to 10,000 units. Remember, 10,000 units is for both products, tables and chairs. Then we need to calculate targeted quantity to be sold per each type of product. Total table sales equal to 20% times 10,000 units equal to 2,000 units of tables. Total chair sales equal to 80% times 10,000 units equal to 8,000 units. Next, calculate the estimated profit for next year. Remember how to calculate profit for managerial accounting. Profit is calculated from total sales revenue minus total variable cost equal to contribution margin. Then subtract the value of total fixed cost will give you total net profit. Let's have a look for this company. Sales revenue from tables 5,000 times $100 per unit equal to 500,000. Chairs 20,000 unit times $50 per unit equal to 1 million. total sales revenue 1.5 million for these two types of product, minus variable cost for tables 120,000, for chairs 200,000, total variable cost 320,000. The difference between sales revenue 1.5 million minus 320,000 variable cost will be total contribution margin 1,180,000 minus total fixed cost 280,000 for the year, equal to a total profit of $900,000. So this is an example of CVP analysis for multiple products. CVP analysis and break-even analysis are underpinned by a set of important assumptions. Key assumptions include the following. First, the behavior of costs can be neatly classified as fixed variable or semi-variable. Cost behavior is linear. The number of units produced equals the number of units sold. Fixed costs remain fixed over the time period and or a given range of activity. Unit price and cost data remain constant over the time period and relevant range. For multi-product entities, the sales mix between the product is constant. What do you think of this assumption? Are the assumptions realistic in practice? It is true that some assumptions may not be realistic. If the condition and environment for the entity fall outside this assumption, for instance, not all costs can be easily classified as fixed or variable, then such analysis is of little benefit. However, CVP analysis is still a very useful tool for planning and decision making. We need to be mindful that the result of CVP analysis may not be that accurate if some specific assumption cannot be met.